You are welcome to this lecture. In this lecture, we'll be looking at Unit 3, which talk about accounting for property, plant, and equipment. Accounting for property, plant, and equipment. In the previous sessions and units, we look at some individual standards. For instance, in Unit 1, we look at fair value measurement. In Unit 2, we look at accounting for financial instruments. We look at the individual standards that deals with financial instruments. And in this unit, we'll be looking at accounting for property, plant, and equipment, which is IAS 16. And in this session, we'll be looking at the scope and definition of property, plant, and equipment. The scope and definition of property, plant, and equipment. At the end of this session, it is expected that you should be able to 1. Outline scoped out items of property, plant, and equipment. 2. Define property, plant, and equipment. And 3. Give examples of items of property, plant, and equipment. So these are the session objectives we have to achieve at the end of the lecture. The scope of IAS 16. This standard shall be applied in accounting for property, plant, and equipment, except when another standard requires or permits a different accounting treatment. And this applies to property, plant, and equipment classified as held for sale in accordance with IFRS 5, non-current asset held for sale and discontinued operations. So when the asset is being held for sale, the standard that deals with it is IFRS 5, though it is property, plant, and equipment, but you apply IFRS 5 because of how it has been classified instead of applying IAS 16. B. We have biological assets related to agricultural activity other than burial plant. Now, when you look at IAS 41, talk about agriculture, and any asset, any property, plant, and equipment that is related to this agricultural activity must be accounted for under IAS 41 agriculture and not IAS 16. Then we have the recognition and measurement of exploration and evaluation assets. And the standard that deals with this is IFRS 6. And this IFRS 6 talks about exploration for and evaluation of mineral resources. So if the property, plant, and equipment fall under the exploration for and evaluation of mineral resources, you apply IFRS 6 to that. Then D, we have mineral rights and mineral reserves such as oil, natural gas, and similar non-regenerative resources. So if the property, plants, and equipment is relating to this mineral right, mineral reserve, and the areas of oil, natural gas, and similar non-regenerative resources, IAS 16 does not apply. However, IAS 16 applies to property, plant, and equipment used to develop or maintain the assets that are described from B, which is non-current asset held for sale. Move down to biological asset. We move down to the recognition and measurement of exploration and evaluation of assets, and then the mineral right. Any property, plant, and equipment that is used to develop these items, they must be accounted for under IAS 16. Remember, they are used, or the equipment are used to develop or maintain the assets that are used in these individual standards. Now let's look at the definition of property, plant, and equipment. When we say PPE, what comes to mind? How does the standard defines it? Now, property, plant, and equipment are tangible items. And when we talk about tangible items, they are the items that we can see, feel, and touch. So you can see it, you can touch it. They are tangible. So property, plant, and equipment are tangible items that are held for use in the production or supply of goods or services, for rental to others, or for administrative purposes, and are expected to be used during more than one period. And with period here, we are talking about more than one accounting period, more than 1 year, or more than 12 months. So we are saying that they are assets, or they are tangible items that are held for use in the production. So you are using these for the production or for the supply of goods or services, or you are renting it out to others, or you are using it for administrative purposes. And as such, they qualify to be property, plant, and equipment. And then you expect to use them more than one accounting period. With that, you can classify them as property, plant, and equipment. Now, in the definition, we look at cost. When we say cost, cost is the amount of cash or cash equivalent paid, or the fair value of the other consideration given to acquire an asset at the time of its acquisition or construction. So that how much it costs you to be able to put up the asset in acquiring it, or you yourself building it, or any fair value that you have to use to exchange in order to acquire that asset, is what we call the cost. Then we have another term called residual value. Residual value. Residual value of an asset is the estimated amount that an entity would currently obtain from disposal of the asset after deducting the estimated cost of disposal, if the asset were already of the age and in the condition expected at the end of its useful life. So we are saying that the residual value is the amount you will get maybe after disposing, after selling off the asset and taking off the liability, the cost you incurred and disposing it of. What is left is the residual value. So the residual value you can currently obtain is what we are referring to as what? The residual value. So the amount you obtain from selling the asset and after taking out the cost involved in you disposing it, if the asset is still in its condition at the end of its useful life. Now another term we need to define is entity specific value. Entity specific value. Entity specific value is the present value of the cash flows an entity expects to arise from the continuing use of an asset and from its disposal at the end of its useful life, or expect to incur when settling a liability. So what is the present value of all the cash flows that you have envisaged to realize from the use of the asset and from what? Disposing the asset at the end of its useful life, or the value that the cost you incur when you are trying to settle a liability. So that is the entity specific value. It is different from entity to entity. Now we have fair value as we have been defined in unit 1. The fair value is the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date, and we have explained this thoroughly in Unit 1. Then we have another term called the carrying amount associated with PPE. The carrying amount is basically the amount at which an asset is recognized after deducting any accumulated depreciation and accumulated impairment loss. So mostly we liken it to net book value. We take the cost of the asset, we subtract its accumulated depreciation, then what is left is the net book value, which is the carrying amount. How much are we going to carry the asset in our books now? Then we have an impairment loss. An impairment loss is the amount by which the carrying amount of an asset exceeds its recoverable amount. So we have a whole standard on this which we'll be looking at subsequently. When we talk about impairment, there is impairment if the carrying value of your asset is more than the recoverable amount. What it basically means is that the value at which you are recognizing the asset in your books is more than what you will actually receive when you sell it. So there's going to be a loss. If the thing is 50 cedis in your books, you go to the market, you can only sell it at 40 cedis. The difference of 10 become impairment loss, which is the excess of the carrying amount to or over the recoverable amount. Then we have depreciation. Depreciation is the systematic allocation of the depreciable amount of an asset over its useful life. That is a systematic allocation of the depreciable amount of an asset over its useful life. Now, what do you mean by depreciable amount? Depreciable amount is the cost of an asset or other amount substituted for cost less its residual value. Is the cost of an asset or other amount substituted for cost less its residual value. Now we want to look at the last term or definition relating to IAS 16 property, plant and equipment, and this has to do with useful life. Now useful life is the period over which an asset is expected to be available for use by an entity. The period over which an asset is expected to be available for use by an entity, or the number of production or similar units expected to be obtained from the assets by an entity. So we are looking at two aspects here. It is either the useful life or the period is going to cover, or the number of units that it can produce, which will determine its lifespan, and that is the useful life we are talking about. So in this session, a session summary, we have been able to look at the scope and definitions of IAS 16 PPE. I will encourage that you go back, read them, understand them, because we'll be using the terms in the subsequent sessions. Thank you.